Hey everyone, and welcome back to Microsoft Sphere. The news cycle is moving at warp speed, and staying ahead of the curve is more critical than ever. We've got a packed show today with updates that you absolutely cannot afford to miss. Get ready, because the landscape is shifting, and we're here to break down exactly what you need to know. From game-changing strategies in the tech world to mind-bending ideas that could reshape your entire creative process, we're diving deep into the stories that matter. Let's get right into it. First up, we're looking at a major player in the software tech space that's facing intense scrutiny over its AI strategy. Is the company adapting, or is it falling behind in the AI revolution? We've got the inside scoop on whether its recent market performance is a sign of weakness or a setup for a massive comeback. You won't want to miss this deep dive. Next, we're exploring a powerful concept that challenges everything you thought you knew about creativity. Prepare to have your perspectives flipped as we uncover why questioning your most deeply held beliefs might be the secret to unlocking your next big breakthrough. This is about breaking free from the chains of convention and embracing a new way of thinking that could redefine your work. Then, we're switching gears to a revolutionary new tool that promises to shake up the document management world. Could this be the ultimate replacement for a long-standing industry standard? And at a price that seems too good to be true? We'll tell you all about it. And finally, we're pulling back the curtain on the technicals and analyst opinions surrounding a major tech stock. What does the data say, and what are the experts predicting for its future? Stick around for all these essential updates and more. Don't forget to like, subscribe, and hit that notification bell so you never miss a beat. Adobe's AI gamble: will bulls laugh last? With its market value experiencing a significant downturn over the past year, Adobe finds itself at the epicenter of the artificial intelligence debate within the software technology sector. The narrative is twofold. On one side, the disruptive force of AI, coupled with an influx of free or low-cost creative tools, has ignited widespread concerns that the company might be ceding its long-held leadership in the creative software domain. Conversely, Adobe's leadership appears to be strategically countering these fears, demonstrating resilience through robust execution on its premium product offerings and the swift monetization of its AI capabilities. Despite a 37% drop in share price over the last 12 months, intensifying market skepticism, the prevailing sentiment suggests Adobe is missing out on the AI opportunity. However, a closer examination of operational indicators and management's discourse points towards a different reality. There's a compelling argument to be made that Adobe is strategically positioned for a significant resurgence, making it a prudent long-term buy at current valuations. The adage, "he who laughs last, laughs loudest," seems particularly apt here, as the company prepares to unveil and execute a comprehensive AI integration masterplan. It's a familiar scenario. When you dominate a niche market, you become the primary target for competitors. The creative software space is no exception for Adobe, especially with AI poised to revolutionize the industry through accessible, often free, tools. These anxieties about Adobe's market position have been a significant driver behind its substantial underperformance this year, a sentiment further amplified by the company's more cautious financial guidance. However, Adobe's management team asserts that these concerns are largely unfounded. In a recent interview, CFO Dan Durn articulated that Adobe does not operate in a simple, winner-take-all market. Instead, the customer base is segmented into two primary categories. 1. Billions of business professionals and consumers seeking intuitive, democratized content creation tools, and 2. Creative and marketing professionals for whom Adobe's sophisticated suite represents the lifeblood of their work, demanding precision, power, and enterprise-grade workflows. In essence, while accessible AI generative tools like ChatGPT, Canva, and Midjourney may capture the attention of casual users, the vast majority of professional creators in enterprise settings continue to require, and will likely continue to depend on, the depth, integration, and advanced capabilities that only Adobe provides. Management's key message to investors is that high-end users demand more than just functional tools. They require accuracy, compliance, seamless workflow integration, and predictability. complex challenges that free tools typically cannot adequately address. Several critical factors bolster Adobe's confidence in its enduring leadership within the creative software landscape. Firstly, Adobe is actively demonstrating AI monetization at scale, a feat many competitors are still striving to achieve with free or experimental offerings. This is clearly evidenced by its current $3.5 billion in AI-influenced revenue, with Firefly integrations already seamlessly embedded within Photoshop, Illustrator, and Express. Considering Adobe's substantial annual revenue base of approximately $18 billion, this $3.5 billion figure represents a significant achievement in relative terms. Furthermore, new AI products launched in the past year have already generated an annualized book of business totaling $125 million, with management projecting this figure to double within the next 3 quarters. Achieving such rapid scaling for a revenue stream exceeding $100 million in under a year underscores swift adoption among Adobe's core audience of enterprises and marketing professionals. Crucially, the company's fundamental financial health remains exceptionally strong. The forecast for the current fiscal year anticipates double-digit growth across the board, with consensus estimates projecting 11.7% year-over-year EPS growth and 9.6% revenue growth. Operating margins are expected to remain robust at 47.5%, generating approximately $2.5 billion in operating cash flow and a record $20 billion in remaining performance obligations, RPO, which are also growing at a double-digit rate. These financial metrics indicate Adobe's capacity to invest in innovation while simultaneously delivering value to its shareholders. The company's consistent execution is the cornerstone of its overall investment thesis. Should Adobe continue to meet or exceed these performance benchmarks quarter after quarter, as the growth trajectory of newer, free AI tool providers begins to plateau, the market is likely to recognize Adobe as a definitive leader in the AI space. Another significant indicator of management's unwavering conviction in Adobe's future prospects is the aggressive share buyback program, even amidst declining stock prices. Between 2022 and 2023, a period when Adobe's stock depreciated by approximately 40%, the company repurchased shares worth roughly $12 billion. In 2024, with shares down nearly 30%, approximately $10 billion was repurchased. Collectively, these buybacks from 2022 to 2024 represent about 14% of the company's current market capitalization. From a shareholder's perspective, this strategy is highly beneficial, as reducing the number of outstanding shares inflates earnings per share, EPS, thereby accelerating reported growth and increasing shareholder yield without the need for dividend payouts. However, this approach can also create a mixed market perception regarding innovation, potentially implying a preference for share reduction over substantial reinvestment in future growth. Indeed, major technology firms that have thrived during the AI boom are typically those signaling significant investments in AI, rather than those prioritizing shareholder returns, a contrast exemplified by companies like Apple. Furthermore, as Adobe's market valuation continues its volatile trajectory, there's a perception that some of these buybacks may not have been optimally timed, raising questions about capital allocation efficiency. Nevertheless, because EPS continues to benefit from these buybacks, the market may still acknowledge their long-term advantages, even if short-term price movements remain unpredictable. Overall, market sentiment towards Adobe remains moderately optimistic. Out of the 28 analysts covering the stock in the past 3 months, 19 recommend a buy, 6 maintain a neutral stance, and 3 advise sell. The average price target set by analysts is $482.08, suggesting a potential upside of over 35% within the next year. Broadly speaking, it's relatively easy to adopt a bearish outlook on Adobe at present. Prevailing AI trends do not seem to inherently favor established SaaS leaders, and Adobe, perceived as vulnerable to market share erosion by free AI tools, has been categorized within a winner-takes-all narrative in the creative software sector. While a quantifiable threat to Adobe's core business model does exist, The company has already demonstrated clear pathways to monetize AI effectively, rather than being passively disrupted by it. I maintain that the ongoing buyback program, which some may interpret as a diversionary tactic, while the company supposedly loses its competitive edge to emerging AI players, successfully boosts EPS. However, it can also foster a particular market perception. This would be a significant concern if operating cash generation were weak, which is clearly not the case here. In conclusion, I view the buyback strategy favorably, particularly considering the company's historically compressed valuation multiples. Given the inherent asymmetry in the prevailing winner-takes-all narrative surrounding AI in the software industry, I recommend acquiring Adobe stock at its current levels. But what if the very foundations of your creative process are built on shaky ground? Next, we explore how questioning your most fundamental beliefs could be the key to unlocking your true creative potential. Question everything, the path to creative liberation. Have you ever held a belief so firmly that you defend it to the last? For many creatives, myself included, that might be a stance on language, a rule of composition, or a design principle. I used to be staunchly against the colloquial use of literally to mean very. Armed with righteous indignation and my trusty style guide, this perceived grammatical sin infuriated me. However, my rigid stance was challenged when I discovered that this usage wasn't limited to casual speakers or teenagers. Luminaries like William Shakespeare, Charles Dickens, and Jane Austen employed it similarly. Seeing Dickens's prose in Nicholas Nickleby, perhaps you know, Miss Trotwood, that there is never a candle lighted in this house, until one's eyes are literally falling out of one's head with being stretched to read the paper, was a revelation. It confirmed that these literary giants used literally for emphasis, as hyperbole, essentially for everything except its strict dictionary definition. Faced with this evidence, who was I to declare them incorrect? This realization was seismic. If a deeply ingrained belief about language could be overturned, what other creative truths had I been clinging to as security blankets? What unexamined assumptions were stifling my work while I smugly congratulated myself on adhering to the rules? This phenomenon isn't exclusive to writing. Across art, design, photography, and filmmaking, professionals often internalize wisdom that functions more like dogma than adaptable guidelines. We collect rules like protective talismans: never mix certain typefaces, white space allows content to breathe, always adhere to the rule of thirds, conflict is essential for narrative, purple prose is detrimental, never make the logo larger. These maxims become so ingrained in our creative DNA that we cease questioning whether they genuinely serve our goals or merely keep us within the confines of mediocrity. The issue isn't that guidelines are inherently flawed. Rather, we often elevate them to the status of immutable laws, when in reality, they are frequently historical preferences codified by influential voices. Consider the rule of thirds in photography, often treated as a sacred text. Its prevalence stems from certain Renaissance painters finding it aesthetically pleasing. Yet, filmmakers like Wes Anderson have built entire careers and distinct visual identities on the foundation of dead-center symmetry. Regardless of one's opinion of his films, his compositions are rarely described as boring. While the rule of thirds remains a valuable general guideline, treating it as an inviolable doctrine is a form of creative self-sabotage. There's an undeniable allure to rules. They provide a sense of certainty in an unpredictable world, acting as a roadmap when the creative landscape feels vast and uncharted. More pragmatically, adhering to established guidelines can save time and resources by allowing us to outsource some decision-making to predecessors. It's akin to creative comfort food, familiar and reassuring, even if ultimately limiting. As a former magazine editor in the print industry, I spent years operating under the assumption that good design should be unobtrusive, that the most effective creative work shouldn't draw undue attention to itself. This led me to commission pieces that were competent and professional, but often lacked memorability. It wasn't until I encountered a design that was deliberately, brilliantly attention-grabbing, and highly effective that I realized I had conflated good design with safe design. The most transformative moment in my career wasn't mastering a new technique or software. It was a shift in perspective. It occurred when I dared to break a rule I had followed religiously, and the world didn't end. Embracing the possibility that everything you believe you know might be incorrect can sound like self-inflicted intellectual hardship. However, from personal experience, it is the gateway to profound creative liberation. When you release the need to defend your assumptions, whether they originate from within or from external sources, you open the door to exploring new possibilities. When you stop treating guidelines as absolute truths, you can begin to use them as springboards for further innovation. My advice is to start small. Identify a creative rule you've never thoroughly examined and commit to deliberately breaking it for a week. If you're a designer who typically avoids drop shadows, experiment with incorporating them liberally. If you're a writer who shuns sentence fragments, try scattering them throughout your work. If you're a photographer accustomed to natural light, consider integrating flash photography. The objective isn't necessarily to prove the rules wrong. They often exist for valid reasons. But to understand their origins and assess whether they genuinely align with your creative objectives or merely serve to assuage your creative anxieties. This approach isn't about becoming an iconoclast who rejects all structure. It's about evolving from a rule follower into a rule understander. The distinction might seem subtle, but its implications are profound. Rule followers are constrained by their existing knowledge. Rule understanders are empowered by their willingness to question. This applies, quite literally, to every aspect of the creative process. But what happens when the very tools we rely on become outdated or overpriced? Next, we reveal a powerful new contender in the document management space that could change everything. Adobe Acrobat replacement arrives, a lifetime deal for just $30. A new contender has entered the arena, poised to challenge the long-standing dominance of Adobe Acrobat in the PDF editing and management space. For users seeking a more affordable and potentially more flexible alternative, a compelling option has emerged: PDF Expert, now available for a one-time purchase of just $30, offering a lifetime license. This aggressive pricing strategy directly targets the premium cost associated with Adobe's subscription model, which has been a point of contention for many individuals and small businesses. Adobe Acrobat has long been the industry standard for handling PDF documents, offering a comprehensive suite of tools for creating, editing, signing, and managing PDFs. However, its subscription-based model, often requiring ongoing monthly or annual payments, can accumulate significant costs over time. This has created a market demand for more budget-friendly solutions that still provide robust functionality. PDF Expert, developed by Riaddle, aims to fill this gap by offering a feature-rich application at an unprecedentedly low price point for lifetime access. PDF Expert has been steadily building its reputation as a powerful and intuitive PDF editor, particularly for macOS and iOS users. Its feature set includes advanced editing capabilities, such as modifying text and images within existing PDFs, adding annotations and comments, filling out forms, and merging or rearranging pages. It also boasts robust OCR optical character recognition technology, allowing users to convert scanned documents or images into editable text. Furthermore, the application supports secure password protection and redaction of sensitive information, crucial features for professional document handling. The $30 lifetime deal is particularly noteworthy. In contrast, Adobe Acrobat Pro DC typically costs around $19.99 per month for an annual commitment, or $29.99 for a month-to-month plan. Over several years, the cost of Adobe's subscription can easily exceed several $100s, making the PDF Expert's lifetime offer a significant saving for consistent users. This pricing strategy is a clear signal that the company is looking to capture market share by offering exceptional value. Industry analysts suggest that while Adobe's established ecosystem and brand recognition are powerful advantages, the aggressive pricing of alternatives like PDF Expert could disrupt the market, especially for users who do not require the full breadth of Adobe's enterprise-level features or who are highly price-sensitive. The availability of a powerful, lifetime-licensed PDF editor for such a low cost could sway a considerable number of users, particularly freelancers, students, and small business owners who manage their budgets carefully. The success of PDF Expert's new pricing model will depend not only on its affordability, but also on its continued ability to deliver a stable, user-friendly experience that matches or closely rivals the functionality of its more established competitor. Early user feedback on this new pricing tier has been largely positive, with many praising the value proposition. However, the long-term implications for Adobe's market position remain to be seen as more users potentially migrate to more economical solutions. But is affordability the only factor to consider when evaluating a company's future? Next, we delve into the complex world of stock analysis, examining technical profiles and analyst sentiment for a major tech player. Adobe's technical treadmill, navigating mixed analyst sentiment. Adobe, a titan in the creative software industry, is currently navigating a complex financial landscape characterized by a weak technical profile and divergent analyst opinions. While the company's strategic initiatives, particularly its integration of artificial intelligence, aim to secure its market leadership, the stock's performance and the market's perception present a mixed and often cautious outlook. Understanding these dynamics is crucial for investors seeking to gauge Adobe's future trajectory. The technical analysis of Adobe's stock reveals several concerning trends. Over the past year, the stock has experienced a significant depreciation, shedding approximately 37% of its value. This underperformance has been exacerbated by broader market skepticism surrounding the company's ability to effectively counter the disruptive influence of AI-powered, often free, creative tools. Technical indicators suggest a bearish momentum, with the stock trading below key moving averages and exhibiting patterns that point towards potential further downside if immediate support levels are breached. The stock's current valuation, despite the price drop, is still considered high by some metrics when compared to its growth prospects, especially in the context of increased competition. Adding to this complexity is the mixed sentiment among financial analysts who cover Adobe. A significant portion of analysts maintain a positive or buy rating on the stock, citing Adobe's strong fundamentals, its dominant market position in creative software, and its proactive AI strategy. They point to the company's substantial revenue streams, robust cash flow generation, and ongoing share buyback programs as indicators of financial health and a commitment to shareholder value. The average price target set by these analysts suggests a considerable upside potential, reflecting confidence in Adobe's long-term strategy and its ability to monetize AI integrations effectively. This group believes that the market is currently undervaluing Adobe, viewing the stock's decline as a temporary setback rather than a fundamental erosion of its business. Conversely, a notable minority of analysts express caution or recommend a hold or sell rating. Their concerns often center on the competitive pressures from AI disruptors, the perceived slow pace of Adobe's adaptation to the rapidly evolving AI landscape, and the potential for market share erosion. They question whether Adobe's premium pricing strategy can be sustained in an environment where increasingly capable free alternatives are readily available. Some analysts also highlight concerns about capital allocation, particularly the large-scale share buybacks occurring even as the stock price has fallen, suggesting a potential misallocation of resources that could otherwise be invested in innovation or acquisitions. The company's financial reports do provide some counterpoints to the bearish technical outlook. Adobe has consistently demonstrated strong revenue growth, albeit at a slower pace than in previous years. Its remaining performance obligations, RPO, remain high, indicating strong future revenue commitments. Furthermore, the company is actively integrating AI, such as its Firefly generative AI model, into its core products like Photoshop and Illustrator, aiming to enhance user experience and create new revenue streams. The management's confidence in its AI monetization strategy, evidenced by the rapid growth of AI-influenced revenue, is a key factor supporting the bullish analyst sentiment. However, the market's reaction to these developments has been tempered by the overarching narrative of AI disruption. Investors are closely watching Adobe's ability to translate its AI investments into tangible revenue growth that outpaces the competitive threat. The technical weakness suggests that the market is currently pricing in a degree of risk that outweighs the positive fundamental indicators for many traders and investors. The upcoming earnings, reports, and product updates will be critical in either reinforcing the bullish outlook or confirming the bearish technical signals, potentially leading to further price adjustments. Ultimately, Adobe's stock performance will likely hinge on its execution of its AI strategy and its ability to clearly articulate and demonstrate value to both professional creators and the broader market. The divergence in analyst opinions underscores the uncertainty surrounding the company's future, making it a stock that requires careful monitoring and a nuanced approach to investment. So, while the tech world buzzes with AI and new tools, what's really capturing the audience's attention? Let's recap the biggest stories and find out. And that's a wrap on today's essential updates. We saw Adobe doubling down on its AI strategy amidst market skepticism, explored how challenging your core beliefs can unlock creative breakthroughs, discovered a budget-friendly lifetime deal for a powerful PDF editor, and analyzed the mixed signals surrounding a major tech stock's performance. Don't miss out on future insights, like this video, subscribe to Microsoft Sphere, and ring that notification bell. Plus, let us know your thoughts in the comments below and follow us on all social platforms to stay connected. We'll see you next time.